Thank you, Dan. I want to say I really appreciate you having me. I think we've done this once before, and I want to welcome everyone. Thank you for attending this session. I do believe this is the last session of today's presentation, and for me, of course, that's saving the best for last. But who am I and what is my market experience? We're talking mastering market direction and timing. You should know a little bit about where I come from. My love of the market started on the trading floors of the Chicago Board of Trade in the 80s. There were thousands of traders on the trading floors. And today, the floor is pretty much gone. There is really no more trading floor. We have some options in the financial pits, but those, from what I hear, are going to be all gone within a year. So what you're looking at now doesn't exist. And for me, that's pretty. It was pretty sad to see this take place. You have to note here the Chicago Board of Trade started in 1848, so the floors were around a lot longer than computers. Now, in the 90s, I was asked to manage Futures Learning Center for Futures Magazine Group. At that time, Futures Learning Center was the premier destination for trading education. It was also the place every self-proclaimed market guru came to market their stuff. And in 2006, I came to work for the Commodity Research Bureau, which at the time was owned by Barchart, as educational director. And this is where I began Trends in Futures in 2011. I do know that there's going to be a time after the presentation to ask questions, so please hold off on any questions until that question and answer session. I'll be happy to answer anyone's question after the presentation. Now for me, we always talk about market timing and market direction. Before you even do that, I do believe you need to define a market's condition. And how many market conditions are there? Well, you're looking at what I believe are the only market conditions that are actually out there today. And I don't care if you're intraday trading or if you're day trading, if you're swing trading, if you're position trading longer term. I'm not quite sure, how many of you trade today, but I do know that, I'm looking to catch a trend intraday. I'm looking to catch trends on daily charts, looking at weekly charts too. But that's what I'm looking for. I'm not looking for getting in every bar and getting out every bar. I'm not looking to make 20 or 30 or 50 trades a day when I'm day trading. I do day trade and I do position trade these markets. I only day trade 4 markets. Everything else, I'll look, if it looks good on a chart, I'll be looking to take the trade. So looking at market conditions, what are we looking at? We have a weak trend weakening. We've got a weak trend strengthening. We have a strong uptrend starting, a strong downtrend starting. We've got a strong uptrend strengthening. We have a strong uptrend weakening. And we've got a strong downtrend strengthening and a strong downtrend weakening. I've asked this of thousands of traders in the last few years, and I mean thousands of traders, to send me one more condition that they know of in a market. And I'll be happy to add it to this list, and I've never seen that take place. And of course, you've got price action with these conditions. When you have a weak trend weakening or a weak trend strengthening, you're seeing the price action in a range. You've got a strong uptrend starting, that market's rising. And of course, that could be starting within a range. So you could be seeing a market rise at the bottom of a range where you think you're swing trading, and all of a sudden that market breaks out of that range and you've got a strong uptrend starting. That's where you want to catch these trades, whether you're, again, day trading, swing trading, or position trading. You've got a strong downtrend starting, which the market's dropping. And then you have situations where a strong uptrend is strengthening, market price action is rising, strong uptrend weakening. Then you have a situation where you've got price action dropping. And this is where price action can get quite choppy. Also, what are you looking for when a strong uptrend is weakening? You're looking for a range to develop. Many times when strong uptrends, and when you have we see this on charts all the time, when you see a strong uptrend for a length of time, whether it could be weeks or months even, and that trend starts weakening, the market heads right into a range before it starts either going up again or coming down again. And then you've got a strong downtrend strengthening, which of course the price action then is dropping, and then you've got a strong downtrend weakening. Again, the price action is rising here, but price action becomes choppy. This is where price action becomes choppy, and you've got to be very careful. And then, of course, in the same situation, you're looking for a range to develop. And then you start realizing you're starting to trade that market. If you're swing trading, you're now swing trading. And this also works on intraday charts. So I'll be showing you charts, daily charts, weekly charts, and I'll be showing you how I trade a 5-minute bar chart later in the presentation. So the first thing I want to talk about today, after you define market condition, and how do you define market condition? And that's exactly what I'm going to show you right now. A successful trading strategy must quickly answer, what is the strength or weakness of trend? That's how you define market condition. Are buyers or sellers in control? I'll show you how to do that in a moment. Is a market overbought or oversold with the connection to strength of trend? I don't know how people use something like RSI or stochastics without having a connection to strength of trend. If a market's overbought, where's the strength of trend? You need to define this if you're using those type of indicators. What is the momentum of current price action? And of course, for me, how is big money moving in the market? Now, I do believe many of you have downloaded or hopefully downloaded the book that you were offered, and that's a book that I wrote called What Lies Beneath All Trends. It's the second edition. It covers the new commitments of traders reports, both the disaggregated report and the traders and financial futures report. Those reports are different than the old legacy report. And I'm not going to go deeply into the COT because you have that book handy. If you want to know the history of the Commitment of Traders report, if you want to know why the changes were made back in 2009, 2010, that's all in the book. But the new reports are far more transparent how big money is moving through the markets than the older report was. So, what do I teach at Trends and Futures? I teach my own trading strategy, which one of the members years ago actually referred to as common sense trading, so that's where the name common sense trading strategy comes from. It is basically common sense. When you'll see what I'm talking about in a moment, but this is my favorite common sense indicator. This is the indicator that if someone said to me, you're stuck on an island, you could only pick one indicator to use, this is the indicator I would be using by itself. I would prefer not to do that because I use other indicators for confirmation and other situations where you'll see my favorite trade setup, and you'll see why it's my favorite trade setup also in a moment. But this is my favorite common sense indicator. And it happens to be something called ADX, or Average Directional Movement. This was created by Wells Wilder, and again, I'm not going to go deeply into that, but ADX is part of the Directional Movement System. ADX is aligned. Its own purpose, its sole purpose is to tell me strength of trend. It's not going to tell me what market direction, it's not going to tell me if the market's going up, it's not going to tell me if the market's going down. It's only going to tell me strength of trend. Remember what I talked about with the market conditions, defining market conditions? Also, part of that directional movement system is DI plus and DI minus. DI plus measures strength of buyers, and DI minus, in a common sense way, measures strength of sellers. Again, remember what I said about a trading strategy. And think about this. There's 8 market conditions, only 8 that I know of. There's an awful lot of services out there today that'll sell you trading strategies for each market condition. They'll say, oh, you need a trading strategy for this and that, and they'll be happy to sell it to you. I use one strategy to trade all market conditions. And you'll see how that works in a moment. So this is ADX and simple rules of ADX. And I do believe this is being recorded, so I don't think you have to worry about writing this down very quickly, because I know I've done this before where people want to write this all down very quickly. Rules of ADX, again, measuring trend strength, nothing to do about market direction. ADX value 0 to 20. This is not, there's no strength of trend here. This is a weak, what I call a weak trending market. I see ADX values between 20 and 25. That's a transition period. If I see ADX numbers drop below 25 and head down to 20, I'm calling that a weak trending market. Now I do videos every day for the members of Trends and Futures, and I explain what's going on in the markets every day. We also recommend trades that I cover every night where we're looking to get in and get out of markets. We cover 47 commodity markets, 20 Forex pairs, and we have about 23 ETFs on there that are related to commodities. But this is where I define the strength of of the trend. 25 to 40, we see a strong trend developing. And this is when things take place. If you see 40 get hit in ADX, sometimes the market does come back a little bit. But if you see 40 to 60, it's a very strong trending market. And if 60, you're looking at extreme strength in the market. I've seen that many times. ADX numbers get to 80, and that could be in a move up or a move down. It's a long-term, strong downtrending market, extremely strong. And people will say to me, "Oh, I missed the trade from a month ago. Is it okay for me to get in with ADX numbers at over 60?" That's pretty tough to say. I'd rather see people catch these trends as they start, kind of like a train running, leaving the train station. You want to catch these when it takes place. It's a lot easier to jump on one of those trains leaving the train station as the train starts moving, running alongside that train, than standing in front of it. So just be real. I really push to catch these moves when they're taking place. Again, for the longer term trades, even on intraday charts. Like I said, I'll show you that on charts in a moment. But this is the rules of ADX. Again, no market direction here. There's no market direction here at all. However, when you look at the rules of the Directional Movement Index, and this is really simple. I mentioned DI plus is buyers, DI minus are sellers. If DI plus is over DI minus and what I call DI differential, this is something I show at Trends and Futures. At Trends and Futures, I created tools years ago that were not even part of Trends and Futures. They're actually Excel spreadsheets that we actually brought into Trends and Futures. DI differential is what I look at. If that number gets below 5, it turns yellow on the spreadsheet we look at the site, and that's the time for me to start looking at the market to get ready to get into these trades. Not necessarily on an intraday level, but on the longer-term position trades or even option trades. But DI plus is over DI minus, and DI differential is rising. Buyers are taking control. If ADX numbers are at 23, 24, 25 here and start rising, you've got a strong trending market up. Other side of that, DI minus is over DI plus, and DI differential is rising. Same thing, but that's a strong trending market being with sellers are in control. So the market's coming down. And that's where this is the market direction. This is where and that's why I plot ADX on DI plus and DI minus on the charts. And you could use these on intraday. And you'll see I'll present you daily charts and weekly charts in a moment and show you what I look at. So basically, we're looking at a chart now on the bottom, and we're looking at putting it all together with ADX and DI plus and DI minus. You've got a cross up over 25, and it's rising, ADX. You got DI plus over DI minus, and DI differential is rising. You're looking for a long position here. You're looking for the market to continue to go up. You've got a other side of that, it's cross up over 25 and rising, and DI plus is over DI minus, and DI differential is rising. You're looking to short the market. Action, strength is coming. You're looking to short the market. You've got ADX above 40 and dropping, and DI plus is over DI minus, and DI differential is dropping here. You're in a long, and you might be looking to adjust your stops, looking to get out of the trade. And the opposite, of course, is ADX above 40 and dropping with DI minuses over DI plus and DI differentials dropping. You're short the market, and now you're looking to possibly exit the trade with your, when you want to get out of the trade and take your profits. I wouldn't recommend giving back that much, but I'll cover some of the exit strategies in a moment too. But looking at the chart on the bottom, and again, this could be any chart. And you may be able to guess this chart, but that's not the issue. The issue here is here's a situation with the red circle here. What am I looking to do here? Again, this is not something to just jump into the market. When you see the red line cross the blue line, I don't get into that. You want to look at price action. That's what I'm looking at. You're looking at levels, and you'll see what exponential moving averages I use. But this is where I'm looking to short this market. Right when you see this taking place, I start opening my eyes to the opportunity of a short in this market. And you can see what takes place with ADX is this green line right here. ADX numbers are coming up. Something is happening. Something is strengthening. A downtrending market is strengthening. And you can see how long you would held on. This is a very nice trade. This actually was a very nice trade. And then you have a situation where something is weakening now. Remember I said there's a situation where the price action gets really choppy here. and it does. But this is a weakening trend, and it becomes a weak trending market. Weak trending markets, and now we have buyers taking control here, some strength of trend, but not much. And then again, a weak trending market, and it starts all over again. And here we've got, again, November, DI minus crosses up to over DI plus, and a very similar thing takes place like we saw back in here. Strength of trend develops, you're looking to short the market. It's really, I don't want to say it's simple because some people might not understand this, but it's the idea that, you know, successful trading is not easy, but it doesn't have to be complicated. And if you get a strategy that gives you everything you need to understand market direction, and you have a system that tells you market condition, here's your timing. This is all timing tools that I will show you and how to use them. So this is putting it all together using ADX in the Directional Movement System. And again, if I was told I have to use one indicator and I can't use anything else, someone put a gun to my head and said you can't use anything else, this would be the indicator I'd be using. But I'd rather not do that, and you'll see why. Now, I do want to say one thing. I know a lot of people think what you're looking at right now on the screen is a four-letter word in commodities today. I don't know why. Fundamentals, again, I would prefer using technicals to fundamentals. If someone said to me, you've got to pick one or the other, I'd, of course, use technicals because that helps me with my timing. But fundamentals are why markets move. It's not what moves the markets. It's just why markets move, and we've seen whatever the market you're looking at. I could talk about grains and the supplies of grains and WASDs reports that come out in grains that are very bearish right now. You talk about what happened on Friday with some of the positive economic news that came out, and I'll highlight that on some of the intraday charts today. But it's the fundamentals that come out. China does something. What happened at the first of the year? China came out December 31st. And said, they're not looking so good. Manufacturing doesn't look good in China. Everything's still slowing down. And look what happened to the markets on the first of the year. I was the January 4th. I was telling everybody it's time to look to short the stock market. Something's not. And again, I'm not saying anyone's trading on December 31st because I'm not trading on New Year's Eve. That's when that report came out. I think it was at 8 p.m. that night, that New Year's Eve night. So. For me, fundamentals, I do cover trends and futures. I cover the important fundamentals. I tell people what to expect a week ahead and what those fundamentals can do to the markets today. Today is interesting. Why is today interesting? We had a crude report come out today. That's the EIA crude inventories report. And the EIA crude inventories report came in and said what? It gave a very bearish look at crude oil. 10.4 million barrels added to crude. That's huge. We're sitting on an awful lot of crude oil today. But what's happening in crude? Crude bulls are very, very resilient today. Crude oil is up. Right now trading at 34.70, up 30 on the day. But we had this huge amount of crude oil. We got now, I think we have over 515 million barrels in storage. This is huge. But why is crude oil going up today? We also have a situation where we see unleaded gas demand going up. We saw that last week. We saw that this week. These are all fundamentals that I will cover on trends and futures every day. But again, I'm not going to go deeply into what fundamentals do what. I mean, we had a sugar situation last week that came out. It was a huge move in sugar. I explained to people why that took place, and we move on. No one called me and told me Jose, who was the head of the ISO, was going to make the announcement he made. This is what happens. You get caught in something like that. If you're on the wrong side, not a good thing. So you have to know what's coming out so you're prepared. So that's all I'll say about fundamentals. But what I'm going to cover next, to me, is a fundamental. Now, in futures, unlike most other markets, we have something for measuring buyers and sellers. Now, this is different than DI plus and DI minus. This is more of actual buyers and sellers. We've got volume and we've got open interest. Now, the total amount of contracts, long or short, traded for that day is volume. No matter what, if you're buying, selling, doesn't matter. That's open interest is the total number of contracts, long and short, that are entered for that day. defined basically saying if for open interest to go up 1, you need a new long and you need a new short. For it to go down, you need someone to exit a long and exit a short. And that's how open interest moves. More importantly, and listen very carefully on this one, today, large commercial and financial institutions make up 70 to 80% of open interest. Now, what does that mean? Well, that's exactly what it means. Open interest today, we've got some money out there today that wasn't there before 1999. I'm going to show you that in a moment. But before 1999, before Glass-Steagall was taken out, and that was an act put in 1933 to stop big banks from doing what they're doing today. And today, what are we looking at? We're looking at something called the Commitments of Traders Report. And this is what, again, the book hopefully you downloaded and had a chance to read. And this is the old legacy report that I talk about in the book, the new disaggregated report that came out in 2009, where they added 4 categories instead of 3, removing non-reportables and bringing in producers and swap dealers, managed money and other reportables. The new report, the disaggregated report, is 100% correlated to the legacy report, meaning producers plus swap dealers equals commercials on top, and managed money and other reportables equals non-commercials. There's no more non-reportables that are really important to look at. At this point, people ask me, well, what group do you follow? You know, in the old report, many people say, well, you follow commercials, because they're in the know of the markets. And you could say yes, you could say no to that, but yeah, we did follow commercials. I even have something at Trends and Futures called the Commercial Tracker that I created about 18 years ago, and that was strictly for commercials, and it happens to still be there because it still works today. And then you've got, a year later, and I was involved, and I don't want to say I was involved in this, but I used to call the CFTC all the time in 2006, 2007, and complained that I saw the legacy report doesn't look right anymore, especially when we talk about seasonals. The legacy report didn't look right, and they came out with this new report to take out swap dealers. Now, Traders of Financial Futures came out a year later. It is not correlated at all to the old report. You've got dealer intermediaries, asset managers, leverage funds, and other reportables. You can read all about this at the CFTC.gov website. At the CFTC.gov website, they define dealer intermediaries as the sell side of the market. What does that mean? I'll show you that in a moment. Now, why is this important? Is this really a big deal? I mean, is it? I mean, who knows? Maybe you're looking at this. This comes from the Bank of International Settlements. Real quickly, just to show you quick what kind of numbers we're talking about. With notional amounts outstanding, this is the global over-the-counter derivatives market. This is in billions of US dollars. All contracts, these are all derivatives, commodities, everything. In the second half of 2013, that's $710.6 trillion of notional amounts outstanding. And you see the numbers drop, 691 trillion, 629 trillion, 552 trillion of notional amounts outstanding. If you want to see the whole spreadsheet of this, you can go to, again, BIS.org, Bank of International Settlements, and you could actually just type in global over-the-counter derivatives markets. You'll see all the stuff on there. But what I'm showing you more than anything else here is foreign exchange contracts. You can see, how that works. And why are interest rates so high? That's because the big banks have always been involved in trading interest rates and foreign exchange. That was their business. They never were really involved in trading even the S&P or gold or corn or anything else. Today, they're in everything. So for me, following these people, or actually not following, knowing what they're doing is kind of important. And even for gold, it's funny how they separate gold by itself under commodities. Look at gold. People are wondering why isn't gold trading at $2,000, $3,000 an ounce like everyone was saying. This is gold. And if you really want to watch a very good video on trading gold, I did 2 videos. Actually, one in 2012 saying gold prices are going to come down. That was in a gold fever video, and I did just part 2 recently talking about the gold bull coming. So at this point right now, this is where how big money is now moved into our markets. And just real quickly, people get a kick out of this. There's 4 banks that dominate the derivatives markets. And you can see very clearly here, this is for the U.S. commercial banks. You're looking at about 191 trillion in notional value. Top 4 banks, you can see very clearly they pretty much control, they dominate the derivatives markets here in the U.S. And if anyone wants to try to guess what those 4 banks are, you're more than welcome, because I'm about to show you that in a moment. But if you're really thinking about who these big banks are, think about some of the banks that have been fined over the last year and a half for what they did in 2008 or what they did to cause the financial crisis. Real quick, this is just something the top 4 banks: J.P. Morgan Chase, Citibank, Goldman Sachs, Bank of America. Your top 4 banks. And my favorite bank to look at on this screen is Goldman Sachs. Why? Total assets is $127.6 billion. JP Morgan, Citibank, and Bank of America, even Wells Fargo, much larger assets. 1.9 trillion at JP Morgan. Total derivatives notional values here at $51.9 trillion. That's what they're exposed to, this JP Morgan Chase. This is as of September 30th, 2015. Again, this comes from what we call the OCC, controller of the currency here in the U.S. And here's Goldman Sachs with $127.6 billion with $43.6 trillion. And they're hanging out with the big boys, even though they don't look that big. And they're also the most boisterous bank talking about commodities. And I'll show you that in gold in a moment. So this is why you want to, not necessarily, this is not a timing tool. This is just, again, market direction. Where's the market heading, and what's the bearishness or bullishness of big money in any market? And I'll show you how to define that very quickly. So ahead is what I call common sense trading. And my common sense trading strategy, which is just ahead, is real simple. Again, if you're going to want to write these down, you might want to write these down on a daily chart. My common sense trading, I use candlesticks. I use an exponential 4, 9, and 18-day moving average. We have something, our ADX at Trends and Futures is modified. It's what I call a modified ADX. We use calculations just a little bit differently, but we have a 14-period ADX on a daily chart. We've got a 14-period DI plus and DI minus. I use a 14-period stochastics. As a secondary indicator, I will plot MACD, and I probably do that for more or less for a lot of the other customers, and volume. And MACD is basically your general 12-26-9. Now, one thing I want you to keep and understand when you're looking at these charts is that when a market's overbought and it's a weak trending market, how long do you think it's going to stay there for? Other way around, if a market's overbought and it's a strong trending market, how long do you think it's going to stay there for? And that's what I'm talking about with my favorite trade setup. Favorite trade setup? Weak trending market in overbought or oversold territory. The market's not going to stay there very long, usually. And I'd say 7 out of 8 times the market's going to turn around and exit that overbought or oversold condition. Not always, usually. Now, on a weekly chart, common sense trading on a weekly chart. 6, exponential moving average is 10 and 20. ADX is brought down here a bit by 10. ADX modified is 10. Stochastics 12 or 10, depending on the market I'm looking at. And of course, I post on all weekly charts of Trends and Futures the commitments of traders reports, both reports. Some people are used to using the old report. It's easier to teach them how to use a new report by showing both. And that's what I do on the site. All the weekly charts have that information on there. Now, the charts I'm about to show you are effective close Friday, February 26th. And things have taken place between now and then, but this is what we're about to take a look at. And the first chart I'm going to show you here is gold. And this is an April 2016 gold. And we look at this and we say, okay, what's taking place in gold? This is for position trading, not day trading. I'll get to that in a moment. But when you look at gold today, and what you see here are red lines and green lines, this is common sense trading, or what we call CST signals. A red CST, a green CST. What's the red CST telling me? I'm looking for a short in gold, and here's my exponential moving averages. My 18-period exponential moving average is what I'm looking to get below to take a short in gold, especially with everything lining up like we see. The market's correcting out of overbought territory. Here we see it, right here. DI minus is crossing up over DI plus, and ADX numbers start climbing, and the market becomes a strong trending market up. But wait a second, I'm not going to get into this trade. It's in deep oversold territory. Okay, it's okay. Why? There's strength to trend here. Strong trending markets will remain oversold longer than weak trending markets. Catch a move like this down. And again, at Trends and Futures, I do tell people where I'm looking to get out of these trades to pocket money and waiting to get back in. And just like I mentioned earlier, as a strong trending market comes down and starts weakening, many times the market gets into a range. Weak trending market, the market's in a range. Here, we've got a green CST. Is it a good green CST? It doesn't look great because it's not, we're not seeing strength of trend. We do see DI plus crossing over DI minus. And here, this black line, are you looking to go long on this break above 1100? You got to be careful here. You could take it. You want to, control your risk here. But keep in mind, it's a strong trending market. It's a weak trending market. Excuse me. It's a weak trending market in overbought territory. Weak trending market in overbought territory. That's basically that's my favorite trade setup. That's where I'm looking at the market to move, and it does move. It does correct down. You see gold correcting down from 1100, and that's why you have to be very careful in some of these trades with regard to strong trending markets, weak trending markets, in overbought or oversold condition. Now the next green CST, the market's not overbought right now, and it's got room to grow, and it does. But this time we have strength of trend, and I'm not concerned about the overbought condition. Now back up here, February 12th. What was February 12th? It was a Friday. And then we have a situation where we have President's Day comes in here. And then what we get from the exchange, unfortunately, on official closes, we have to wait for February 16th. This is February 16th. This red candle here is February 16th, not the 15th. And when I tell my customers and tell the members of Trends and Futures, you have the largest open trade equity close in a long that was taken right up here. You have to adjust your stops accordingly. What I mean by that is you have to adjust your stop. What I like to do, now this trade happened to have an awful lot of money in open trade equity in it, over $15,000 in the long that we took. But keep in mind, that's where you have to adjust your stop from. And you don't adjust your stop, you're going to get stopped out on this way down. And then you have to wait to get back in. You're like, oh, wait a second, what? No, you've got to learn how to pocket money in trades. And again, I stress that whether you're managing $3,000 of open trade equity or $2,000 of open trade equity, you have to adjust your stops accordingly. Market's strong trading market up, gets into a little range right now. The market's still in this range. It's between 1240 and 12. Market hasn't closed above 1240 yet, and we see gold down. At this point right now, in the past week, gold's up now, but it's still, right now, gold's trading at 1239.90, just below 1240 here. I need to see a close above 1240, and for this move up to continue, I need to see consecutive closes above 1260 for that bull to continue. Now, on a weekly chart, and here's where you want to start understanding market direction. You want to master market direction on a chart? Here it is. This is a strong trending market up. ADX numbers are 57.5. This is a strong trending market up on a bounce off of 1060. Market's coming out of oversold territory, but here's big money, and here's what you need to understand about big money here. Producers, are normally your sell side of the market. Swap dealers in gold. Swap dealers actually in all precious metals are hedgers. They're not speculators. Why is that? I think it might be because some of the ETFs out there today, like GLD or SLV. That might be why swap dealers are actually hedgers in these metals. They're not this way in copper, but they are in precious metals. So you look at this and you say, okay, what's taking place? Well, if sellers are adding, if the sell side of the market's adding to their net shorts, this is a net position, adding to their net shorts, and swap dealers are adding to their net shorts, and the buy side is adding to their net longs. This is what is referred to in this situation off this red CST. Again, we have these on weekly charts and daily charts. This is what's called bull moves. And then I will tell people every week when I start seeing a bullish posture. That's different than a bull move. Bull move can take place in a bearish posture or a bullish posture. But these are bull moves, and I will call the the bullish or bearish posture when I see that taking place at trends and futures. And you'll say, oh, this is not true. Well, you can look at any chart, any gold chart, any chart you see with big money. This is a bullish posture. I know people want to sit there and say, well, I want to wait to the extremes. Well, wait a second. You're waiting to an extreme, you're missing the move up. And here, again, swap dealers become net long. This is a bear right here. This is a bearish movement. And this happened in November 2015. And you see gold prices come down. And you can look further out. You want to go, you can go as far out as you want with this and say, look at all these charts and see when you see price action like this and you see big money posturing. Again, not a timing tool, but this is something you'll understand by saying this market is going to continue to go up. Yes, it would be nice if you can close your eyes, go long, and forget about everything else, but you really can't do that because, with a move like this, you see this doji candle here, almost doji candle here, the long wick. With a move like this, and you see that taking place, you're kind of giving back a lot. You don't want to give back that much. You want to pocket your money. The market could drop further below 12, which it didn't do. But again, better to err on the side of pocketing money and waiting to get back in the market. Again, this market's trading, weak trending market. What happens? Choppy price action. Weakening trend, this is what you could expect to take place. And here, this is a daily and weekly chart. And this is gold. And this is, again, you catch these moves underlining this, this trend. And this is when I say the book is called What Lies Beneath All Trends. Here it is. Now in crude oil, I love trading crude oil. This is actually two markets I day trade. I day trade gold, I day trade crude, and I day trade actually the E-mini S&P and soybeans. But it's the idea here, and when you're looking at this, you say, okay, what happened? Again, red CST here. Market's coming down from above 50. I'm looking for a shorting opportunity. There's my 18-period exponential moving average, and we see a break below that area. I'm looking to short the market. Again, I'm not picking tops and bottoms. I don't believe that's possible. And you start catching some nice moves down. A strong downtrending market took place. See that right in here. We have some weakening trend. You see some choppy price action, a few days of a range, maybe a week-long range between 40 and 38. Another red CST here. Market comes down, and you know where we're playing at right now in crude oil. 30, we broke above 34, and now everyone's looking at the market at 34. I'd rather see the market get above 36 as far as a bull taking place in crude oil. We have a weak trending market in crude. Even with the move down we saw, ADX numbers are at 16. It's a weak trending market. The M plus is just crossing up over the M minus, and we do see that, again, this is as of Friday. MACD is definitely bullish here, and stochastics start getting near the area of being overbought. And crude oil, again, fundamentals today play a role in what's taking place with the demand of unleaded gasoline. But again, here we go. Big money. The last time we saw crude oil at $105 a barrel was when? July 2014, maybe further out to June. What caused the drop? Well, look, the sell side was selling here in crude oil. Swap dealers are also hedging crude. And they're the strong sell side of crude oil, which is not normal. I'd like to see what's taking place today because producers are supposed to be the ones who are the strong sell side of the market. Back in here, even if you go back to when crude oil was trading at $110 a barrel, what was happening? Swap dealers were the only group net short. Even producers were net long back then, which again, swap dealers weren't really here back before 1999. So once, Glass-Steagall ended and the banks got involved in commodities, this is what takes place. You want to see a nice bull run up? Here you go. You see producers and swap dealers adding to net shorts and managed money adding to net longs. You see gold, this is crude oil, go from 45 to 60. And look at $60 a barrel up here. Look at that right there. Market didn't want to close above $60 a barrel for how long before the market came down again? On liquidation here. Managed money dropping net longs. And here we saw, I thought we'd see something take place here with producers adding to net shorts, which is bullish. However, all of a sudden, swap dealers are running for the door. and this past week, I will tell you this past week, this little green line. We did see a bull move with swap dealers actually liquidating that longs. And if you at Trends in Futures homepage, I was interviewed by a guy named Phil Flynn. He's a Fox Business News contributor. We had a talk about my predictions in crude oil, and what happens when this green line gets below zero and starts heading deeper below zero. Crude oil prices are going to be going up. Keep an eye on that. You'll see what takes place. So this is crude oil and how you use common sense trading here. And again, I get more specific at the website, trendsinfutures.com, on when to get in, when to get out, and when to pocket money, looking to get back in. It's important for everyone to learn how to make pocket money when you're trading. Looking at the Dow, this is again, we have the situation with the stock market. Here's the Dow. The Dow, real simple. Again, I do day trade the E-mini S&P, and I don't necessarily position trade. But you have the same thing. December 31st, you have a red CST looking for a break below 17,000 here, and you see the price action come down. Strong trending market down. Now, if you see a strong trending market down and you're day trading, what are you looking for when you're day trading? Think about that. And keep in mind, is big money doing anything in the Dow? Here, green line, straight down. You see what's taking place? Big money. Big money is doing what they do. You see, it's very simple to say, okay, well, they're actually bullish right now. They're adding, the sell side is selling and the buy side's buying. This is not defined by me that dealer intermediaries are the sell side of the market. This is defined by the CFTC. They've said that they're the sell side of the market. And even on a weekly chart, again, we see common sense trading, the CST has signals that come up, and then I'm looking at the moving averages. For me to look for an entry point to get into the market short, into the market long, and this is not something I look at on a daily intraday chart, on a 5-minute chart. You can't look at the COT, but this is where we're at today. And it would be great to see this every day movement by big money, but that's not something that can happen at this time. At this time, this data is released on Fridays, and I cover this on the site. In Trends in Futures, I tell everyone if this is bullish, if this is bearish, bear moves, bull moves. I tell that people to help them manage their trades. Now, again, soybeans, and I'm not sure how many of you trade futures. If you want to learn how to trade futures, we definitely teach people how to do that at the site. But here's a situation too. 885 became a solid area of resistance or a top of a range. Red CST, market comes down. Short-term trade, you're not going to be holding on for a month or anything. And then you have a green CST. And we're looking to get out, take profits, look to get back in. Now, of course, soybeans are dropping further. There's a lot of bearish fundamentals out there putting weight on soybeans right now. Not just the strengthening dollar. Also, Brazil is harvesting their largest bean crop, and that harvest is going quite well. And again, same thing on big money. You want to see beans go from 950 to 1050. You need to see this take place with big money. It won't happen if it's. And again, this price action is not going to take place without this buying and selling moves the markets. You saw that when I was on the floor. I used to even question that on the floor. So, you see corn rallying, and you run up to see what's going on, and you see corn rallying, and people are screaming buy and sell. Who's selling? Well, this is what's happening. And at that point, open interest is going up. So someone's opening up new shorts. And here, last week, we did have a bull move. But this is a bull move in a bearish posture. Bearish posture still. And look at soybeans right now. And after soybeans, here's the U.S. dollar. U.S. dollar, same thing. Looking back to July 2000, back in here, July 2014, market moves up off of 80. What's happening here? Something's taking place. The dealer intermediaries are doing their job. They're selling into the U.S. dollar. And what's happening in the U.S. dollar? The U.S. dollar is coming up. Nice rally in the U.S. dollar. How many of you caught this move up based on, this is it. This is how big money moves the markets. U.S. dollar, Forex, which I'll show you in a moment. But right now, I still see, in this past week, we had a slight, what I call a bear move and a bullish posture. This is still a bullish posture here. Slight bear move. And of course, Other things take place with the U.S. dollar moving up and down. Of course, we had talk about a Fed rate increase this year. Is that going to take place? The dollar comes up. It's just talk right now. And it happened last year also. But underneath this, something's taking place. Euro-US dollar Forex pair. Here's the Forex pair right here. Euro-US, and again, it's the same thing. Green CST here, bottom of a range, 108. What happened on the 29th of January? Bank of Japan introduced negative rates. It was unexpected. The US dollar rallied. Everything else came down. And then this market continued to go up. Would it have stopped on its ride up here if the Bank of Japan didn't do that? Probably not. But here, same thing, red CST. But more importantly, if you trade Forex, look at the Euro futures contract weekly chart. Straight here, again, back out here, we see something taking place. Dealer intermediaries are not supposed to be net long if you're looking at a bull. If you're looking at a bear, and this becomes a strong bearish posture, the market comes down. And this is how they posture. Recently, we've seen some bull moves in a bearish posture. And just recently, we saw dealer intermediaries become net short. And I thought, oh, this might be the time where we're going to see a breakout. But that's not happening right now. And of course, last week, we saw a drop of net shorts. Not a huge drop, but a drop in net shorts. So at this point, I'm still going to call this a bearish posture, and the market's still dropping. But if you see this red line start heading south and this blue line come north, hello, bull in the euro or even the euro-US dollar. US dollar, Japanese yen. The Japanese yen has been one of my favorite currencies to trade. And one of the big reasons for that is, back when the new prime minister took over, or the new president, he said that he was going to drop the yen, and he did. But here, US dollar, Japanese yen, red CST. This took place February 2nd. Big move down for the US dollar, February 3rd, and that has continued. But you look at the Japanese yen today, on a weekly chart, on the futures contract, this became a bull move, and I'll call this right now, this is where I call this, this is at this time, a bullish posture. We haven't seen that since probably back June, July 2012. This red line's been north of zero since that time. And we have situations where you see a strengthening bull and a weakening bull, or a strengthening bear and a weakening bear. Here, when this takes place, you see the price action. And, I thought back out here we might see something take place with a bull, but that didn't take place because they went back to the strengthening bearish posture. And you see what happens with the Japanese yen. And of course, again, the fundamentals here, what's the Bank of Japan going to do? Again, I'm not being told what they're going to do ahead of time. But this is how you can really gauge what market direction. And that's how you use this to either, if you're going to day trade, you want to look at, again, if you're day trading Forex, you're looking in place. This is a strong trending market down. Throughout the day, you're probably looking to catch the longer moves down than the moves up. Let's see if that takes place. So now, just real quick, I'm going to show you a couple charts on the 5-minute chart, and this is my 5-minute chart trading strategy. Again, I look at candlesticks. On a 5-minute chart, I have an exponential moving average 1020. I have on a 5-minute chart, ADX, it's a 10. DI plus and DI minus are both 10, and stochastics are optional 10. I don't necessarily have to look at that. I could just day trade with just ADX, but I do look at stochastics sometimes, again, to see what's taking place, strength of trend, and many times I'll look back. And when I'm day trading, I always do this. And I think everyone should really consider, when I get up in the morning, now I live in Chicago, so I'm up at around 5 o'clock a.m. I'm doing some of my stuff that I do in the morning. I don't turn my computer on until about 5:45, 5:50. And when I turn my computer on, I look back at the price action overnight. I actually map out what I'm looking at as far as overnight goes with lines on the charts to see where we see support, where we see resistance. And I pretty much see what's taking place. Many times you'll see the European market set the stage for a long trend up or a long trend down, or even at night, with the Asian markets. So I keep an eye on that, and that's how I gauge, numbers I might be looking at to trade above or below if my technicals tell me it's time. So this is back from Friday. Friday's 5-minute gold chart. Again, 6 a.m. I'm getting up. I'm lining out some of these numbers, but keep in mind, I know something's happening. We have GDP coming out for the U.S. and we've got some other information coming out at 9 o'clock, and these are at 7:30. It's that all the times I have in the bottom of these charts are all Central Time. I know we're basing things on Eastern Time, but at this point right now, 7:30. Look what happened. 7:30. This is the red candle right here. But before that took place, you said the market's correcting out of overbought territory. It was a weakening trending market, and I'm talking about a 5-minute chart now of gold. And you see what takes place. You got a strong trending market down. And then you have now this is a 20-period exponential moving average. I use both. I look at these for crossovers. I look at these for price action to get below these areas. There's a red CST here. Now again, not all red CSTs are just telling you to jump into the market. It's telling you to look for the opportunity. I'm not looking to day trade 20 or 30 or 50 times a day. I'm looking to catch intraday trends, whether it's 2 or 3 or 4 trades a day. That's it. I'm not looking to, again, do all that, because again, for me, that's not being a successful trader. I know people that do this, but I don't get into that. And I know a lot of people who are very successful day trading, the intraday trend, and that's it. And then you see what takes place after 9 o'clock. You see that we got a really interesting bar here at 9 o'clock. And that data, once it got digested, it was bearish gold. And once this drop takes place at 10 a.m., you start seeing some weakening trending markets. And green CST here, market starts coming up, and then you see what we saw. We saw some strength of trend up. This is the only strong bull we saw was between 1 and 2 p.m. on Friday, and that was it. And then we saw the weakening trend, and at the end of the day, we see ADX numbers drop, the weak trending market, and we see where the market closes at the end of the day. But again, I'm not looking to tell you people that if you're really successful as a day trader, that's great, but you could do both also. I mean, I do both for a reason. I don't like to sit there and miss out on a trade in sugar because I'm not day trading. I do like to hold positions in these markets because they're very profitable. You can actually be very profitable if you know what you're doing when you're position trading these markets. I can't day trade 40 markets. I'm not going to do that. I do have my favorite markets that I day trade, and that's it. But this is how you can set up a chart. You can backtest this all you want. But again, solid areas of looking to get into these markets short, and solid areas to get out, and also solid areas to look, for markets when they start turning, helping you get out of these trades. And also, here's a euro US dollar. You're day trading Forex. The same thing's taking place. The same news is coming out that's going to affect the US dollar, that's affecting gold. And this was the news that was coming out, GDP and stuff. This was bullish. The news that was coming out was bullish the US dollar. That's why you see at 7:30 when the report came out on GDP at 7:30 Central Time. That's why you see this large red candle down. Now I know the reports are coming out, this information is coming out, and I see the setup taking place before that information comes out. The strength of trend develops. Okay, if you want to take out some pips out here, you take some pips out here. You can wait to get back in, but this was look at the strength of trend we saw on the move down. And this was all through here also from 6 a.m. This was a strong trending market. Some strength of trend on the move up here that started before 6 p.m. That's why I say you draw these lines out and you know what's coming out. You know something could happen on Friday that's going to move these markets in a big way. And that's exactly what you see take place. Here, before the 9 a.m. report came out, 9 a.m. again Central Time, markets came down before the report came out. And then, the report got digested here, but it was a very, again, a bearish report for the euro, a bullish report for the US dollar. Again, this is, if you might have 3 trades in here all day on the way down to 10 a.m. And when you're done, you've taken out some nice pips, you might be done for the day. Otherwise, you can watch the market become another strong trending market down when you see a correction here. This is a correction. This is no trend here to the move up. What you see taking place is a trend is weakening, and a strong trending market gets into a range. And this is a 5-minute chart. Then we see a strong trending market up again. And again, use these exponential moving averages. You see the price action above this area, you're looking to go long. You can catch a nice ride up as it breaks above the top of this range. And then you see the weakening trend. Weakening trending markets, you start looking to get out, start adjusting your stops. Always trade with stops. I'm a big fan of that. So that's a 5-minute chart. Now I do know we're getting towards the end as far as for questions and answers, but before, I want to just tell you about some things before I let you go. One big thing I know about the industry, and as I ran, running Futures Learning Center and seeing what's taking place over the last few years, 10 years, for me, it's not about the percentage, it's about dollars and cents. I always bring everything into dollars and cents. What's happening in the industry today, or even for quite some time, is everyone talks about, oh, your percentage. What does this mean to me? For instance, even on the news, when I'm listening to the news on the radio on the way into work, driving downtown, or taking the train and listening to the business channels, they'll say something like, oh, crude oil prices were down 3.5%. And they stop. They don't say anything else. Crude oil prices are down 3.5%. What does that mean to me? What does that mean to me as a trader? I have no clue. If someone said to me, crude oil prices were up 90 cents today and I'm long, I know how much I made. But giving me a percentage doesn't help me at all. The idea here is that look at the dollars and cents. I've had people, I get all the information still to this day about, oh, we're up 50% based on buying an option at 300 and selling it at 450. Yeah, but didn't you risk $300 when you bought the option? Well, no, we have a stop to get out at to give back half. Well, now you're risking 150 to make 150, and you're saying it's just some of that stuff drives me a little bit batty because, again, you have to focus on how much money you're putting in your pocket. You're not putting 3.5% in your pocket. How much dollars and cents are you making? Don't let people sell you on percentages. Ask them straight out, how much did you take out of the trade? Give me a dollar figure. Based on one contract. I'm not going to tell you anyone to go out and buy 10 contracts or something. Perfect example of this is a sugar trade I got into on September 25th at 12:10. As March sugar, and yeah, the market came up and it was a nice trade. I had a stop in place on that trade, risking $448. If the market came down against me, I would have lost $448 per contract. But I took out $2,580 out of that trade. What is that? Am I going to tell everybody, oh, I was up 560%? No, I just made $2,580 on a one contract trade in sugar. That's it. I made $2,580. I'm not going to sit there and tell everybody, I made 500% on the trade. Yeah, I risked 448, and I've seen people base that on, their margin, 1487 margin sugar. That doesn't matter. I risked 448. I took out 2580 out of the trade. Dollars and cents. Only focus on dollars and cents when you're trading. This percentage stuff really can get, and that's what people, a lot of the outfits out there that I think are selling snake oil, they use percentages because they're not showing you dollars and cents. Just focus on how much money you put in your pocket. That's why I tell people that all the time at the site, and I show people, here's how much money you're going to put in your pocket if you get out here. And I also have a very interesting place, tell people how to get in and out of a trade, where to place your stops initially. I don't believe in using money stops, but I teach that at Trends and Futures. Also, do not trade what you think. A lot of people tell me, this, and I'm opinionated. You can watch my video on with Phil Flynn on the site. I have my opinions about the markets and where I think things could go, but I'm not trading what I think. I'm trading what I see. Only trade the markets based on what you see, not on what you think. That's a problem for a lot of people. I mean, we're bombarded by things on the news, which I kind of stay away from. I do look at fundamental information, but when you start hearing guys give their opinion on TV, that's not a good thing. It's the idea of saying, what do you see on the chart, and where's the opportunity? try to stay away from, oh, I think sugar. Here, I did a presentation, a webinar for the members of Trends and Futures of where I see markets going this year. I actually did that in the beginning of January. I said I think sugar prices are going to double this year. Does that mean at that time I was going to actually go long sugar and just ride it out? No. As prices came down below 14, I was looking to short sugar. I'm going to short sugar, even though my opinion is that sugar prices are going to rise this year by the end of the year. That's why you have to understand when I say do not trade what you think, trade what you see. So at this point, I do believe I was given about 15 minutes to answer any questions you have. Now, for this webinar, we do have a special 30-day free trial. You could call Jay right now, Jay Brown, at 312-506-8709, or you could, I don't know if you can, if someone could put the URL up on the GoToWebinar screen, but right here, you could go to type in that URL. It's www.trendsandfutures.com/30 days. I'm not looking for a credit card. I'm not looking to lock you into any auto renewals. The fact of the matter is I know I could help you make more money trading in futures and Forex, and I'll give you, just give me 30 days to prove it. No, if you don't make the money you're looking for in 30 days, don't pay for the service. The bottom line is I know what Trends and Futures does for the members of Trends and Futures. I know that they're making money. Some people are telling me they found success they never had before. Some people are actually making more money than they have before. The idea is, for this webinar, you're more than welcome to take a 30-day trial for free. And let me, again, what I do is I do present webinars for the members every Monday night called Common Sense Trading for the Week Ahead. And I outline the markets moving forward, not back, where I see the markets heading and the week ahead. So that's why it's called Common Sense Trading for the Week Ahead. And that's what I do every Monday night for the members of Trends and Futures. After your 30-day free trial, the service is only $49 a month. And that's what we do. You have access to everything at the site. You have access to all my webinars, all my educational videos. You have access to two tools that I think everyone should know how to use. One is called the Futures Trend Catcher. One's called the Futures or the Forex Trend Catcher. Those two tools will save you hours and hours of time trying to find opportunities in the markets. Why? I don't like looking at 40, 50 charts at night. I actually developed this when I got married and had kids. I can't possibly look at all the charts all night long. I'm not spending 3 hours looking for an opportunity. You look at these spreadsheets, those market directions, or the market conditions I showed you earlier, you can look at those spreadsheets and define every market condition, and you'll see every possible trade setup from the Common Sense Trading on those spreadsheets. They're actually, if you look at them, they're really not, they're easy to look at. And the CRB Trend Trader does give specific trade recommendations at Trends and Futures that I cover every day and every night. I do 2 videos a day for the members of Trends and Futures besides the webinar, and that's what we do. So you can actually call Jay Brown at 312-506-8709 to take a 30-day free trial, or just type in that URL, and you're more than welcome to take the 30-day trial. Once you do that, the minute that you do that, you want to sign up for my next webinar coming out Monday night, and we'll see exactly where crude oil and gold and all the markets are headed. I don't trade individual stocks. I know people sit there and say, well, how come, I have heard that my trade setups do work for trading stocks. I don't trade stocks. I trade futures. I trade Forex, and there's a reason for that. But I do explain everything very, very in detail. And if anything, just follow me on Twitter at trendsandfutures.com. I'm not a big social media fan. I'm just trying to work with Facebook right now. But so if you have any questions about anything, about how to use the site, how to, I'm available to anybody. I'm a real person. I do take emails. I do take phone calls. People always sit there and say, well, how can you do that? Because I do. I believe in talking to people, helping people trade successfully. Like I said earlier, successful trading is not easy. If anyone tells you it is, they're selling you something that you shouldn't be buying. But I will tell you that successful trading does not have to be complicated. So if anyone has any questions, I guess you can go ahead and ask away. And if I'm not sure if I'll see, let's see these questions here. Okay, David, you're asking a good question here. I see the questions coming in now. Common sense trading is determined by a few things. I look at the DI minus and DI plus, the DI differential. When that gets below 5, that's when I'm looking at the market. CST comes in when DI minus crosses up over DI plus, or DI plus crosses up over DI minus. That's not a place to just jump into the market, though. So you really need to understand. Shams is asking me about oil again. You have to understand that the common sense trading is not a place to just jump into the market. You start looking at the market for opportunities. That's when things are taking place. That's when you're going to catch the train as it's leaving the station. Let's see here. And Mahesh, I think I answered that question. Mahesh has a question: how do you scan the market to find trades that match your strategy? Mahesh, that's where I use the futures and Forex trend catchers. They're spreadsheets at the site. They are so easy to use, and that's where I put comments about what's happening for the week ahead. And a lot of times I'll place comments on the Commitment of Traders report if I see something taking place that you should be aware of. I keep in touch with the members of Trends and Futures as much as I can to make sure they know what I'm thinking, what I'm seeing. Again, don't trade what I think, trade what I see. Let me just see here. We got a lot of questions coming in. Let's go here. People are wanting to know the success rate of how CST works. Common sense trading, I'll tell you right now, if you look at my setups, the setups that my favorite setup, by far my favorite trade setup in these markets is an overbought or oversold condition in a weak trend. I love those markets. Those markets do very well for me because I know something's about to move. Whether it's a swing trade, now think about this. If you're swing trading these markets, a swing trade, all strong trend trades start as a swing trade. The market's moving off the bottom of a range or the top of a range. How do you know not to get out on a breakout? You have to look at what I show you on these charts. When you look at common sense trading, understand that it's really about market price action and strength of trend. Again, those market conditions, how are you trading a weak trending market? You're trading a market that's trading in a range. You're not trend trading that, it's not a strong position trade where you're going to be in a trade for weeks and weeks, which could happen. That could happen. That depends on how ADX is posturing as far as strength of trend. If ADX tells me, that's one thing I'll tell you, a lot of people try to show you, Fibonacci or Elliott wave. I don't use that stuff for one reason. It's not 100%. What I mean by that is, just because a market gets to a 50% retracement, am I going to throw all my money at that market? No. You have to realize that I know when ADX numbers are rising, something is happening. There's something taking place. If ADX numbers are going up, there's strength of trend developing. That's it. That's all I know. And it's not, if ADX numbers are going from 30 to 40, it's not a weakening trend. It's a strengthening trend. That's 100%. And I use other indicators like stochastics. And I like Wells Wilder stuff. I do use like average true range, which I'm going to be adding to the chart soon. That's where I use to adjust my stops when I get into a trade. When I get into a trade, I'm using average true range to place my stop. If the risk is too great, you don't take the trade. You don't use money stops when you're trading. Okay, yeah, I know people use this for Forex and they're doing very well. So people are asking me, yes, you can use it for Forex. I don't know about the stocks. I'm not going to sit there and talk about stocks because I don't trade stocks. I own stocks, but I don't trade them. Someone's asking me about what broker I use. No, the COT indicator comes from Trends and Futures. It actually comes from the CFTC. But realize that Whitney asked a question, is an open interest the balance at the end? Actually, open interest is usually a day late. So open interest is a day late. Open interest is, again, something I would never look at if I wasn't looking at how big money's posturing in the market. I don't know how people use open interest and not understand what's happening with that open interest. If open interest is rising, who's causing that move up? Big money. I mean, this is what it's all about. Adam's got a question about, I like Thinkorswim. I don't know if you know who Charlie Cottle is. He's the one that actually was one of the developers of that, Thinkorswim. That was bought out by TD Ameritrade. But Adam, I think you can. I don't know if you can put don't look at ADX by itself. It's just gonna tell you trend strength, and it's not gonna tell you which direction the market's going in. So understand that, and it's like Wells Wilder's, average true range. Average true range doesn't tell you if the market's going up or down. It just gives you a really good sign of volatility, and that's important to look at too. I saw that's actually where I started, Sal. I actually started in the bond pit, on the outside of the bond pit. I was a runner and a clerk, and then I became an institutional broker. But the bonds work extremely well. We have a great move in bonds. We actually caught a great move in bonds on a long rate up. But again, if you're day trading, you could do that with T-bonds. If you're not day trading, you're position trading. Again, get on for these rides. This is how people make money trading. What do I see in oil? At this point right now, I'm gonna go live. I mean, I don't have that. I have other screens in front of me, but as far as crude oil is going right now, I see a bullish posture by big money, and it's a strong bullish posture. And I will tell you this: today is a very interesting day for crude oil because for some reason bulls are resilient right now in crude. Let me just make sure. Hold on a second. I'm gonna see where crude's trading at right now. Now, just keep in mind the futures trend catcher and the Forex trend catcher at trends in futures are 10-minute delayed. They're not real time, but you can see what's happening. Crude oil is up 37 right now. And what's interesting to me again is we had this incredible increase in inventories, but we see other things taking place underlying crude oil, like demand for unleaded gases going up. That's going to help push the price of crude oil up. Crude oil is up now, up 37. If in fact on Friday, I will tell you this right now, if in fact on Friday the COT report shows swap dealers getting net short and they continue to get net short, I don't care how much crude oil we have in the world today, crude oil prices are going to go up based on the buying and selling of big money. That's it. They help bring the price action down, they help bring the price action up. At this point right now, there's no trading room. That might happen someday, but at this point right now, it's just basically I do videos every day on the markets. I do a position update, so we highlight our positions, where I'm looking to get out, if we're profitable. I always tell people where I'm looking to get out. If in fact, when we get into a trade and the trade doesn't go with us, you got to get out and minimize your risk and maximize your gains. And that's what we do. I mean, and again, I do stuff that some people find, like how much do I give back on a strong trend? If we're in a long-term trend, how much do I give back? Well, I look to give back 20 to 25% of a trade on anything over $2,000 to $2,500. $3,000 of open trade equity, I'm looking to take out anywhere from $2,000 to $2,250. I tell everybody the exact number, where those numbers are to get out. You have to realize that you have to adjust your stops to where you want to pocket money. People say, oh, there's a right place to get out or a wrong place to get out. No, there's not. Again, we're not picking tops and bottoms here. I'm looking to make money trading. And to me, that's the bottom line. I'm looking to understand how much I'm putting in my pocket from this trade. I'm defining that. I will define where I'm looking to get. Look here, for people sit there and say to me that when you get into a trade, how come you don't have something in stone and where you're getting out? Well, you could say I'm looking to get out here if this happens, but if the market's doing something where you're adding to open trade equity every day, are you going to jump out and possibly miss another bigger move out and move up? No, you adjust your stops with trailing stops. You understand what you're going to pocket. I go to bed at night. I got my trailing stops in place and my position trades. I know people. Oh, you can get stopped. Your stop can get blown through. That doesn't really happen as much as it possibly used to do but today everything's open. All the markets are open. Everything's trading overnight. And I haven't had stops hit overnight where I pocketed money, and you wake up and okay, it's done. Go move on to your next trade. As always, if you miss a trade, I always tell people this: if you miss a trade, don't worry. There's another trade coming. It's like I miss a train on my line. There's trades coming and going all the time. Don't lose sleep over a trade you missed. I don't want to miss the trade. That just happens. I miss a lot of trades. I don't get into every opportunity. I can't. I get into some trades, I hold on to them. I don't like to position trade more than 5 or 6 markets at a time. If I'm trading in 6 markets, I'm managing some nice open trade equity. I might be backing off, even looking at other markets, even with the trade setups I see taking place on the futures or Forex trend catcher. I'm really have to understand that I know my limitations. I know what I can and can't do. It's taken me a few years to learn that, but my best advice I ever got as a new trader, when I started on the floor trading my own account, was a very well-known trader in the bean pit told me to start trading for beer money. And I looked at him, I was like, what are you talking about? He said to me, you're a kid. What else do you need? If you understand that you're trading for beer money and you get consistent trading for beer money, it doesn't take a rocket scientist to figure out what you need to do to trade for other things like vacations and cars and living expenses. And keep in mind, I don't believe in black box systems. I know Trend Trader's been around for a long time. CRB Trend Trader was created in the 60s. It's probably one of the first computerized electronic systems for trends and how to strengthen. The system uses moving averages and a few other things, but a lot of the things that were created by Wells Wilder weren't around in the 60s, and that's a big thing too. But for me, yes, I've had opportunities to meet a lot of people in the business, managing Futures Learning Center. I used to try to get Richard Dennis to do something for Futures Magazine so many times. He was in our office building. He was actually on a 6th floor when we were on the 12th floor. But, he didn't want to do anything. Richard Dennis never wrote a book on this stuff. Richard Dennis never did anything. In a magazine, he wouldn't do any kind of articles for us. He just didn't do that kind of stuff. He just managed money, and he was good at it. But he didn't make money. Think about this for a second. I've seen people actually sit in front of a group of people and tell people that Richard Dennis made his fortune, what helped him make his fortune were stock, or we're trading options on commodities. And I looked at this guy and I was like, this guy's nuts. Because in the 70s, when he made his first fortune, there were no options on commodities. Those didn't take off until the mid-'80s. And yes, if you ever want to talk history about the markets, unfortunately, I know a little bit more than I probably should. But again, if you really want to, again, get into futures, get into Forex, learn how to trend trade some of these markets, I do talk about some of the day trades I get into during the day on the position update, usually done in the mornings. I am looking to do more webinars for the members, and I'm actually in the process of working on a program where I will do a webinar every day for the members at around 10:30, 11 o'clock during the day to highlight the market moves for the day, do the position update, and by the end of the day, I'll be ready to go ahead and tell people what markets we're looking to get into, long or short. Dave, I actually worked for, I don't know if I'm not to ask this, but who did you work for? Did you work on your own? I don't want to start giving out names of who I knew because, oh, okay. I actually worked for Drexel, Drexel Burnham Lambert, and you might recognize that name. Don't get mad at me for saying that. Yeah. Everyone, if they don't know, Drexel Burnham Lambert was in the center of the savings and loan scandal with the junk bonds by Mike Milken. And JJ, you're asking me ET time in the morning. I'm not quite sure what that question means, JJ. What did VJ? That's a question. Again, you could make money. I mean, it's not. I can't tell you. I'm not going to say that you're going to make 10% or 100% on your money, but you can make money trading. You want a specific number? Take the 30-day trial and give it a shot. Paper trade it. Don't trade anything that I'm telling you to do unless you test it first. You should be the one responsible for making your trades. Don't make a trade just because I tell you to make a trade. Make the trade because you know it's a trade you should be making, based on your knowledge, not my knowledge. I'll teach you what I know, but the fact of the matter is, you should know. Here, if I tell you what every trade to make every day, and you're making money, and I get hit by a bus, I'm not saying that's going to happen. I get hit by a bus. Did you learn anything? Can you go off and do your own trades? No. You need to learn how to trade by yourself and make money trading consistently. And it's all it is. That's what I do. That's what I teach at Trends and Futures. You're going back down pretty far. Conti, yeah, that goes back. That definitely goes back. When you say, are you talking about, oh yes, you're more than welcome to do that. Again, control your risk in all your trades. And if you're comfortable with it, I seen that. Okay, I'm not sure you answered that question. 9 a.m. Eastern time. Is that about what time this thing started? Is that what you're questioning? I don't know what the question was for. That's to JJ. But yeah, VJ, you can actually trade them live. If you have a broker, you could. But again, get comfortable with what I do and what I teach. It doesn't take that long. What I teach again is it's common sense. It's the simple aspect of understanding market condition and mastering the market direction and timing of your trades. You don't have to be, again, you don't have to be there. People say, oh, you could have got in here. I'm not concerned about picking tops and bottoms. I'm not concerned about that 10 or 20% move up before I get in. I'm looking to get into the trade and take out 70 to 80% of a move. If you could do that consistently, week after week, month after month, intraday, daily, or weekly, you're going to be a successful trader. How do I define that? If you make money at the end of the year. I can't tell you how much, but you're going to be a successful trader at the end of the year. And I actually will tell you that if you master stuff like this and understand that it takes one strategy to trade the 8 market conditions I show you. Now, if anyone has any more conditions you want to add to that, feel free, send me one. I've challenged thousands of traders on that one. Now, also, when you're at Trends in Futures, you could download 8 years of trade history, and you're at the site. You could request that if you don't want to take the service initially, but you can actually go to the site and see 7.5 years, 8 years of trade history for the Trend Trader product. You can also, there's a lot of information at the site before you even log in, my interview with Bill Flynn, but it's really, again, I'm not trying to, again, the 30-day trial, I'm not trying to lock you into auto renewal or anything like that. Try the service for 30 days. You'll be able to participate in 4 webinars with me on members-only webinars. You ask me questions about trading, whatever you want to do, Forex, whatever. And we talk trading. That's what we do. We talk shop every Monday night. JJ, there's no room, JJ. I don't show people on screens what I'm doing throughout the day. What I will do is I do videos every day, and that's going to be changed hopefully to webinars, where I do a webinar every day for members between 10:30 and 11. You'll log in. We'll spend some time together looking at the markets, and I'll do a position update moving forward and explain to people where we're looking to get out of the trades. I cover everything. I cover everything from stock indices, interest rates. I cover grains and meats. I'll cover metals and energies. I'll cover softs, some of my favorite markets I like to position trade. I'll cover Forex and currencies. I got my start in trading currencies, in trading currency futures in the 80s. There was no Forex back then for us to trade until about 1994. And I asked Leo Malamed this. He was the chairman of the CME. He's the one that brought commodity currency futures to the CME. The whole idea of the concept of trading currency futures. And I asked if Forex was around in the 70s and 80s, would that have taken place? And of course his answer was no. If the Forex was open to everyone to trade, chances are currency futures wouldn't be here, because that would not have been something he was looking to do. But at the time in the 70s, you and I, the banks were still doing it. Banks always traded currencies, the cash currency. That really didn't take off that didn't really get started until about 1994. So, and again, that you had to be careful when that started out too, because there was a lot of really bad people out there that started in Forex, selling that whole idea, what I call bucket shops. And that was, again, when I was at Futures Magazine, they saved a lot of our advertising, because they came in, they advertised when people were leaving because they were being bought out. There was a lot of consolidation in the industry in the 90s with commodity trading. So again, you can call Jay right now. He's waiting for your call, I think. Or you could, if it's easier for you, just go to the link, trendsinfutures.com, 30-day. Once you sign up, you get your password and username, get into the site, sign up for the webinar Monday night. you'll have all time to do that because I will send that out. Actually, I think that should be posted. I think it's posted there now, but if not, it should be posted there in the next day or two. Mr. Young, you're asking a question. I hope this is a Mr. Young, you're asking a question. The yearly membership cost, if you want to pay for the year, is $495, or you can pay $49 a month. So that's after your 30-day free trial. And again, I'm not looking for you to buy anything right now. I want you to just try this for 30 days. If I can't help you make more money trading, then you don't pay for the service. That's it. I mean, I know the game that's played today with getting people on credit cards and auto renewals. It's not a good situation. So if you have any further questions, I'm not sure. It is after. Hank has got an interesting question here, and I will come to that in a moment. But Don, every webinar I do at this is recorded and posted at the site. I have different risk tolerances than most. I'm not a huge risk taker. Some people think I am, but I'm not. People who don't trade think I'm a risk taker, but I'm not. I really kind of calculate what I'm looking at. And I will tell you this right now, if you look at my favorite trade setup, it does work 7 to 8 times out of 10. You'll see that market correct. And it's just all about timing. That's why you got to look at price action. Everything works together with what I do. It's not something that, again, I'm not looking at one thing only, but if I had to look at one thing only and I didn't have a choice, I'd be looking at ADX. But I got to tell you, he was one of the favorite people I ever worked for, hands down. He was actually at my wedding. You could actually ask Dave, ask Joe how much food he ate at my wedding. Just ask him that. Just because we actually gave people seconds and thirds on the main course at my wedding. He freaked out on that one. But he was actually at my wedding. I forgot about that too. That was a few years ago. Now I'm aging myself. But I'm glad to know that Joe's always going to be older than me, though. He's always going to be my older boss. We used to joke around about that also. But he was a great guy. I mean, he was really, I can't say that enough. I mean, he was one of my favorite people to ever work for. So so we're revisiting old days. Anyways, but yeah, if you ever get out here, send me an email. I'd love to do lunch with you. And if you want to, I don't know, any questions that anyone else has anymore, just get to the site. If you want, just for the heck of it, just watch my video with Phil Flynn. You'll see something about Phil Flynn. I don't know if you know the guy. Print charts. Hank, we do have print charts here. I used to run commodity price charts. I don't know if I recognize your name or not, but we actually have print charts here through the CRB. We actually combined those two print chart services. If you would like, send me an email, and I'll send you a free set of charts just so you can take a look at them. Now, we don't do these every week anymore, Hank. Hank, that industry has changed a lot. Back in 1997 at Futures Learning Center, we had over 10,000 subscribers to the print commodity price charts. And that's really not, we brought those to computer. If you want to see what those computer charts look like, that's pricecharts.com. But again, I have all the charts at trendsandfutures.com you could use, weekly, daily, monthly, intraday, but not for day trading. You don't use Trends and Futures site for getting in and out of a trade day trading. You have to use your own platform for that. But Hank, I'll be happy to send me an email with where you want me to send them, and I'll mail you a free set of the print charts that we print today, and you can take a look at them. If you like them, I'll be happy to send them to you. And keep in mind, Hank, they're printed once a month now. They're not printed every week. We used to do them every week and every other week. We've moved those out to just once a month. And that's because of what's happening with the computers. And it's unfortunate because a lot of people used to love the commodity price charts. And that's how I got trained on trading. I mean, back in the 80s, what you look at. So again, Hank, if you want, just send me that. And Dan, if you want to, I know people aren't really asking questions at this time. Any more questions? If anyone has any questions, send me out a question now. Otherwise, VJ, you could sign up whenever you like. If you want to sign up today, sign up today. If you want to sign up, just write down that URL. Whenever you're ready to sign up to see if I can help you make money, just type down that URL, and you'll be on your way to. And again, if you want, after you sign up, send me an email. We could chat on the phone even. I do phone consultations. I don't charge for those. So that's it for the day. I do want to thank all of you for joining me today. I do hope what you learned here today helps you have the most profitable trading year in 2016. And I have no doubt that with Trends and Futures and my help, I can help you a lot. I can help you achieve that. As always, as I end all my videos and all my webinars, the most important thing is for everybody to be well. Then you can trade well and follow the trends.